Assalamualaikum warahmatullahi wabarakatuh. Hello, greeting from Indonesia. My name is Mayang Sekar Pembayun Khamisan from Trisakti School of Management. I am the first author in this paper, and I am going to present our paper titled Financial Distress, Tax Loss Carried Forward, Corporate Governance, and Tax Avoidance. So, let's get started. In a daily life, of course we are familiar with tax. When we get salary or income, we have to pay tax to the government. So, what is tax? Tax are compulsory contribution imposed upon people or taxpayers under the law where they will not receive direct compensation from tax. Tax takes the highest position on the state budget structure because tax is the most potential source of state revenue that can be used to finance government programs in order to improve people's prosperity and reduce social inequality. Indonesia has been using self-assessment system in the tax collection system, where taxpayers are trusted to calculate, pay, and report their own amount of tax payables under taxation laws. But in practice, sometimes there are many problems in implementing this system because of differences in views and interests between the government as the tax authorities and the companies as taxpayers. For the government, tax is a source of state revenues, but for the company, tax is an expense that reduces the company's net profit. So, company will try to reduce the tax expense. This gap causes the difference in interest between the government and companies that can encourage companies to control the amount of tax payment. One of the ways that can be done to control the amount of tax payment is through tax avoidance, which is the part of tax planning. Tax avoidance is a legal act that doesn't violate the law because it is not a violation of taxation laws. These are several issues raised in this study, including whether there is an influence of financial distress, tax loss carried forward, and corporate governance, such as institutional ownership, managerial ownership, audit committee, firm size, audit quality, and tax avoidance. So, the research problems in this paper are: first, does financial distress influence tax avoidance? Does tax loss carried forward influence tax avoidance? Does institutional ownership influence tax avoidance? Does managerial ownership influence tax avoidance? Does audit committee influence tax avoidance? Does audit quality influence tax avoidance? Does firm size influence tax avoidance? And last, does return on asset influence tax avoidance? We used two theories in this study that we adopted. First, agency theory. Agency theory is a concept that explains the relationship between principal and agent in performing company activities. Government as the principal expect the maximum amount of tax revenue, while the company management as an agent want to generate significant profit and expect minimum tax payments. And the second theory is tax avoidance. The tax avoidance is strategy and technique that done legally and safely by taxpayers because it doesn't violate taxation provision. Tax avoidance is done by utilizing various weaknesses that exist in taxation laws and regulation. Companies that perform tax avoidance Companies perform tax avoidance to reduce tax payables by doing legal act and do not violate taxation laws. According to research problem that I have explained before, this study aims to determine the influence of financial distress, tax loss carried forward, institutional ownership, managerial ownership, audit committee, audit quality, firm size, and return on asset to tax avoidance. Based on the previous description, the hypotheses we use in this study are: first, financial distress has positive influence on tax avoidance. Second, tax loss carried forward has positive influence on tax avoidance. Third, institutional ownership has negative influence on tax avoidance. 4. Managerial ownership has negative influence on tax avoidance. 5. Audit committee has positive influence on tax avoidance. 6. Audit committee has negative influence on tax avoidance. 7. Firm size has positive influence on tax avoidance. And last, return on asset has positive influence on tax avoidance. Next, for the methodology, this research using SPSS 25th version as a statistic tool for processing data and use multiple regression analysis to test the hypothesis. The companies used in this study are manufacturing companies listed on Indonesia Stock Exchange during 2015 until 2018. The method of sampling used purposive sampling, and the number of research samples used were 162 data. And next, the measurement of variables. For the dependent variable in this research is tax avoidance, which is measured with using cash effective tax rate. Cash effective tax rate is the amount of cash spent to pay tax divided to income before tax or earning before tax. And then for the independent variables, first, financial distress is measured with cash flow coverage ratio by dividing operating cash flow with average total liabilities. Tax loss carried forward will be measured by dummy variables that will be given a value of 1 if at the beginning of year T there is tax loss carried forward, and will be given 0 if there is no tax loss carried forward at the beginning of year T. Institutional ownership calculated by dividing total shares owned by institutional with total outstanding shares. And next, managerial ownership calculated by dividing total shares owned by management with total outstanding share. And for audit committee, measured with total audit committee. And audit quality is a dummy variable, so a value of 1 is given if the company is audited by the Big Four, and a value of 0 is given if the company is not audited by the Big Four. For the firm size, will be measured with natural logarithm total asset. And last, for the return on asset, is earning after tax divided to total asset. And next, the analysis. Below are presented the result of a descriptive statistical test consisting of a minimum value, maximum value, mean, and standard deviation of each variable. Next, the following table presents the result of the test for each variable. As you can see, all of the independent variables in this study have the significant value higher than the significant level or alpha 0.05. Therefore, it shows that all of the independent variables in this study do not have influence on tax avoidance. So, refer to the previous slide, we can conclude that first, financial distress has no influence on tax avoidance. Second, tax loss carried forward has no influence on tax avoidance. And third, corporate governance has no influence on tax avoidance. And for the conclusion, companies that are facing financial distress will always suffer losses, so the need for tax avoidance will be reduced because the companies that suffer losses will be free from income tax expense and get loss compensation facility in the future. Second, tax loss carry forward is not something that is determined by the company in doing tax avoidance, but facilities that can be used by corporate taxpayers. And last, good corporate governance does not guarantee that the company not doing tax avoidance because the presence or absence of institutional and managerial ownership and use of the Big Four public accounting firm cannot prevent the company from carrying out tax avoidance activities. And last, these are the references that I use in making this paper. So, okay, this is the end of our presentation. Thank you so much for your attention. See you again. Stay safe, stay healthy, and stay positive. Thank you.